Hi there, welcome to another live webinar with us from Phillip Futures. This is your facilitator of the day. My name is Sri. And with us in the studio is professional trader Kar Yong, who you've probably met a few times in one of our previous webinars. And today we will be discussing a topic that is on everyone's mind, inflation. As we know, inflation is picking up, and we will discuss what you, the trader, should do this time round. Kar Yong will cover how inflation will impact the markets, what every trader needs to know to reduce risk, and where would the potential opportunities be at the present stage of the post-pandemic recovery. Kar Yong will also touch on key products like the S&P 500, gold, selected Asian indices, and key sectors that you should be looking out for. Kar Yong, if you're all mic'd up and all set to go, please tell us, without further ado, what should a trader do with inflation picking up? Kar Yong.
All right, okay, great. Thanks, Sri. Right, so good evening, everyone. Okay, so let's get started for today, right? So what you see on the screen right now is the QR code. So if you have yet to download the MetaTrader 5 for Phillip Futures, you're able to actually do that just by scanning it. Okay, so later I'll share along as well, right? Some of the instruments that you're able to actually trade on the MT5 platform. Okay, so today's topic, what we're going to touch on, of course, I think most of you are probably also interested to understand and know a little bit more, is with the current inflation picking up. Okay, are we technically in a stock bubble, or is there a potential of a stock bubble building up? And what do you really need to be protecting yourself or taking note of? Okay, and if you actually track the market last Friday, we do have kind of like a dip, and then of course on Monday we also have a dip. Yesterday we did see some early sign of rebounds, but you know, the question is still more of, is it a good time to trade, and are we gonna see maybe a crash, right? A bigger correction and things like that. So today, sharing over here is to really give you some insight, some perspective into this topic, so that you will not panic, or I would say you might have some understanding to kind of prepare yourself to move ahead in the stock market. Okay, so I think you know, if you are today very active on social media as well, you probably come across some of these headlines that you see on the media, right, where you talk about, like, Michael Burry says the market is on the brink of a collapse, and he even called it the mother of all crashes. And then of course not only him, okay, but someone like Jeremy Grantham and of course all other top investors are also predicting a potential market crash coming in, right? And they're all kind of like sharing that, you know, the bearish market is coming, the crash is coming, you need to be aware and things like that. And of course Robert Kiyosaki, if you guys are aware of him, hey, the author of course Rich Dad Poor Dad, also talks about it. And then of course he did mention that he is hedging his portfolio himself by entering into Bitcoin. But of course Bitcoin is another totally different topic right now. The market of Bitcoin has also came down quite a bit, right? And over here, even someone who is really focusing on macro environment, okay, macro analysis, is Stanley Druckenmiller. Okay, he also mentioned this, right? No doubt that we are in a raging mania in our asset, which again translate to a potential market crash perhaps coming. Okay, however, at the same time, of course, before last Friday and recently, the market has been beating and making new record highs, right? Both the S&P as well as the NASDAQ. And that's where I think a lot of traders and investors right now are kind of like conflicted and confused, where you have all these major top investors telling you to be cautious, the potential market crash is coming, but yet at the same time prices are beating record, right? Beating all-time high. But of course last week and earlier this week we did see some kind of pullback. Okay, so the question of course right now is you know, whether you should be investing, should you be trading on the upside or should you be cautious, or should you even look for sell, right? Of course, the big question now for many traders and investors is, so how, right? What next? What should we do as a trader and investor? Okay, so I hope today's sharing over here is able to give you some insights, and of course, not just about me talking about buy or sell, but I think it's important to give you some understanding into some of the metrics, some of the framework that I personally use to track the market. Okay, and hopefully it will be able to help you answer this question here, where you understand, what we are looking out for and how you can protect yourself. Okay, so today we'll be discussing on a few key things. First one, of course, is to directly talk about inflation, whether inflation is something that you really need to keep an eye on. Is it going to be a real threat to our economy and even, of course, the stock market here? How is it going to affect the prices generally in terms of the indices and, of course, some of the stocks in general? Okay, and we'll also talk about how you can protect yourself, right? So what you need to do, what you need to know going into 2022. Okay, and if let's say there's a next potential crisis coming in, how are you going to prepare yourself for that? Okay, so this I think is pretty important. Okay, and last but not least, then I'll share with you a little bit, whether you should be investing, right? Under what circumstances, under what state you should not be investing and trading the market, and then under what condition it will be ideal for you to actually look at it. Okay, so I think this is today's topic, and of course, I'm pretty sure along the way you might have some questions where maybe you want to find out a little bit more, maybe certain parts are not very clear. We do have a Q&A segment. Okay, so I would suggest that if while we are sharing, okay, you do have some questions, do write it down. Okay, because maybe you might forget by the end of it. So do write it down, and then when we come over to the Q&A segment, okay, that's where you're able to ask, right? Okay, so that's where the interaction really starts. Okay, so let's jump straight in and answer this question here. Is inflation a real threat to the stock market? Okay, now instead of me directly giving you like is a yes or no answer, I think it's important to give you a framework into understanding what inflation does, right? What's the consequences, what's the effect it has on the market itself. Okay, so it's through this then you understand the why. Okay, and to me, if today you're able to take away some learning points over here to help you in your trading and investing framework, then I think it's pretty good. Okay, so that's the benefit that you want to take away from today as well. Okay, so let's first understand what moved the market, right? At the end of the day, okay, when you're looking at the stock market as a whole, okay, so we're talking about S&P, the Nasdaq, the Dow Jones, basically the US market. Okay, you need to understand like what really makes the market move. Okay, of course, simplified it, you can just talk about demand and supply, but what really constitutes demand, what really constitutes supply, what are some of the factors that affects the demand side of things, the supply side of things. That's where you'll be able to understand better. You'll be appreciative of how the market mechanics tends to move, and then you're able to trade and invest with more conviction and confidence. Okay, so over here we'll talk about that, and of course to share with you also what's the effect of inflation. Okay, so just now we mentioned about Stanley Druckenmiller, right, where he is also saying that the market right now is in a state of mania. Okay, where a lot of retail traders are actually going in and buying things up, pushing price higher. Okay, so over here I still want to quote him because he's one of the more prominent macro trader and investor out there. Of course, if you are aware of George Soros, he's also a macro trader. Okay, and this quote here from Stanley Druckenmiller, actually frames up what what moves the entire market, right? And when we talk about inflation, this principle here is very important. Okay, so he mentioned this. He says that whatever he do, right, he focus on the central bank, and essentially is the movement of liquidity. Okay, and while a lot of traders are actually looking at the PE ratios, the earnings, maybe looking at some of the fundamentals and price charts, yes, those are important. Okay, but he mentioned over here as a general market, what really makes the market move at the end of the day is liquidity. Okay, so over here, what is liquidity, right? Liquidity is basically your demand. Okay, so just now we talked about demand and supply side, right? So liquidity is on the demand side, where we are talking about how easy a transaction can be done, right? So in terms of a big general market, the macro environment over here, we are talking about how much money is flowing around in terms of the economy and the stock market. Okay, so this part here, when we talk about money, it comes from both the principle of cash and credit, right? Cash, I think, is pretty straightforward. Is really, we are all familiar with that. But the concept of credit over here, okay, is kind of like a loan. Okay, if you think of it, okay, it's like borrowing money. Okay, and that's how credit are being generated. Okay, so you want to understand that in today's context, right, in our economy, we're basically in an inflationary economy where over time, all general prices of goods and services tends to rally. Okay, if you just look back like 10 years ago versus now, a same cup of coffee would have been so much more expensive today compared to the past, right? And if you stretch it even further, right, all the way back in history, last time maybe about 20 cents, 30 cents, you can get a bowl of noodle, okay, way back in time. But today, a bowl of noodle, depending on where you are in Singapore, that's about maybe $2 to $3, right? At some places, maybe even $5, okay? So that's the idea of an inflationary economy, okay? Over time, prices tends to rally, okay? And that's where a lot of credit are being generated, right? It can come from personal loan, it can come from company loans, it of course can come from government debt, right? So these are all credit creation, okay? So you want to understand that cash is not so easily created, right? It requires a central bank to really print physical money, which is what the Fed has been doing last year. But credit is easy to create, right? Because essentially all you really have to do between two entities is to go into an agreement and say that in the future we'll pay you this amount of money, and that's the creation of credit. That's all, okay? And that's the reason why the US can go into huge debt at this very moment, because they can basically create credit, and people say that you're basically using the future's cash flow, okay? So that's the idea of credit, okay? And that's the idea of creation. Of course, the destruction of credit over here is how you wipe clean, right? So sometimes you realize that companies might do that as well, where you declare bankrupt, and then what happened? The entire debt is being wiped, okay? So this creation and this destruction of credit essentially is what drives demand and what drives liquidity, okay? So give you an example, right? Last year, the Fed decided to print a lot of money. They decided to go into spending as well in terms of government, right? The fiscal policy side of things. So what happens is that there's a generation of credit, okay? There's a generation of liquidity, okay? And liquidity is being input, is being flushed into the economy, okay? So over here, you want to then understand how the Fed has an impact in the creation of liquidity and how they control liquidity as well, okay? So there are three levels of players over here. Of course, we always mention the Fed, the central bank. They are generally the largest liquidity provider in the market, okay? Subsequently, you do have the government and of course the corporate companies, and these two here, the government and the corporate companies, are smaller in scale, okay? So they do have a little bit of impact, but at the end of the day, as an investor and a trader who is looking in the stock market, we are focusing more on central banks, okay? And of course, in today's context, we're going to focus on Federal Reserve. Why? Because the Fed is still the major central bank right now, and US dollar is basically still the current global reserve currency. Now, until things change, okay, you want to still put your emphasis on the Fed when we are talking about liquidity, okay? So over here, I'll introduce to you some terms as well. Maybe this is the first time you hear about it, but the term on that cycle is essentially our recession cycle as well, right? Our financial crisis cycle. So you probably would be aware that every a good 7 to 8 years, okay, of course the recent one is stretched out, right? Is prolonged, but on general, about 7 to 8 years we get a recession, okay? And last year we did get one. Before that is 2008, and then of course before that is 2000 and 1992, right? So this is that is also called the debt cycle, okay? It's basically the same principle, just different name. So over here, why will we get a recession cycle? Why would we have the debt cycle? At the end of the day, it's again you can blame it on the Fed, you can blame it on the central bank, but honestly, this is how our economy is functioning right now. Okay, so to understand this a little bit better, I'll share with you more, and we dive into like why the Fed plays a big role in the debt cycle and our recession cycle. Okay, so we know that the Fed is basically the central bank, and it controls monetary policy. Okay, and of course, the government control the fiscal policy. So what is monetary policy is basically two approach, right? One is to print money, okay, which is what we talk about, money supply side of things, right? You either print money or you kind of like do tightening and then you collect the money back and you control the supply of money. The second approach that the Fed can do is basically playing around with interest rate, okay, which is the cost of credit, cost of money. Okay, so two things, right? And you want to understand that the Fed has essentially two key objectives, right? Or you can call it KPI, okay? And this two KPI or this two mandate over here is to drive, number one, to make sure economy is in a consistent and sustainable growth environment. And usually that translates to inflation, okay? And a healthy inflation is about, on average, 2%, okay? In other words, you want to see general economy grow by 2% year on year, okay? And that is generally considered as healthy state, okay? And the second metrics that the Fed needs to hit in terms of KPI is basically employment, right? It's important for the people to get employed, okay? So these are the two key factors, okay? And the idea of how all this starts to tie up together is where you start to understand that the Fed are able to play around with interest rate. They are able to raise it, they are able to cut it. So when the interest rate goes up, that means when they start to do hiking, okay, credit becomes more expensive, or loan becomes more expensive, right? Because today, if you go to the bank and you want to borrow money, the cost of borrowing is basically the interest. Okay? So if interests are higher, the cost of borrowing is more expensive. And if the cost of borrowing is more expensive, people tend to borrow less, and that's where your credit drops. Okay, the demand for credit drops, and therefore the liquidity drops as well. Okay, so there are some keywords here that we are linking up together, right? Hope you can see that. And the opposite is true, which means that if interest rate drops, right, which is what happened last year, then what happened? The cost of borrowing becomes cheaper. People are then more incentivized to go and borrow and spend, and that drives demand up. Okay, so that's how the Fed from interest rate is able to affect liquidity and of course affect the demand of credit over there. Okay, now to give you a good summary in terms of a quick diagram over here, okay, we start from the top left, right, and then it goes in a cycle. Okay, so over here, the idea is this chart here started with interest rate being low. Okay, which is, if you put into context, that's what happened last year. Okay, that's where the Fed actually reduced the interest rate all the way to like 0 to 0.25, right? And when that happened, what is the effect? The effect is that the cost of borrowing is cheaper. Okay, and then what happens is cheaper. People tend to spend a little bit more. They tend to loan more. Okay, that generates demand. Okay, and demand naturally leads to people spending. Earnings starts to go up, and prices then therefore starts to increase too. Okay, which is where we are right now experiencing that, right? Inflation is again hitting pretty high. Okay, the last data came in, inflation is more than 5% as of now in terms of short term. Okay, so that actually demand actually pushes prices up. Prices as it goes up, inflation as general starts to go up as well. Okay, and of course, how does all this ties up together? People starts to have higher wages. Okay, because if normal times, right, of course this year and last year is slightly different, but normal times, as businesses starts to expand, they starts to pay a little bit more, starts to give some maybe bonuses to their employees and things like that. So generally everyone would benefit from it. Okay, and while wages increase, people tend to spend more, and then that becomes a whole loop, right? So with that, that's where it starts to brings about inflation. Okay, general prices tends to increase, and the Fed would then need to come back and prevent what we call hyperinflation, right? They need to control prices such that it doesn't rally too fast. Okay, because if everything starts to rally too fast, then it's gonna spin out of control, and everyone will be in a very panic state. Okay, so what the Fed does, the Fed needs to come back in, and they start to increase interest rate to curb that cycle, and then we'll go into the recession cycle over again. Okay, so this is basically a loop, okay, where it repeats over and over again. Okay, so this is a very good one summary to kind of understand how the monetary policy affects inflation and how does this drives liquidity generally. Okay, so over here, again, in terms of demand side, right, just like I mentioned, we are in an inflationary system where general surface prices of goods and services tends to be rallying over time. Okay, so this is the part where you then understand, because of this, okay, what the Fed can only do is they can keep printing money to curb this inflationary system. Okay, and it's also a vicious cycle where, because they continue to print more money, then we are in an inflationary system. So it's like a chicken and egg thing, right? So you need to understand we are in the environment right now that money supply is just going to keep increasing. Okay, and of course with that, debt is going to keep increasing as well. Okay, so over the past 50 years, right, if you really go and dig deep and go and look for all this data, you do realize that on average the money supply in the US on year, it increased by about 8% every year. Okay, but of course last year itself is different. Last year itself was an increase in 20%, right? That's where everyone was saying that right now this next upcoming inflation is going to be very different. Okay, it's different, right? I agree, and I'm going to show you why as well. Okay, but based on this principle first, right, for you to understand this side of things, for the past 50 years, every year the US has been increasing the money supply for an average of 8%. Okay, of course some year more, some year less, but if you average out, it's about 8%. Last year was an outlier, it was 20%. Okay, so let's just take at 8% as a figure. Okay, and yeah, this one last year we talked about that. Okay, and on the supply side, okay, so if today you look into the stock market, right, you have the generation of credit, which is basically the Fed printing money, and then we know that generally on average it prints about 8% increase every year. Okay, and then on the supply side of things, in terms of the stock market, what controls the supply? Okay, this is more specific in the US side, right? Companies tends to do buyback. Okay, and what buyback means is they basically kind of like take back whatever outstanding shares that's out there in the market to reduce, okay, the supply of outstanding shares, which means that now there are less shares out there for the market to trade. Okay, and generally, again, if you understand demand and supply, if there's less supply, what will happen is that prices will tend to shoot up, right? So on the average, okay, companies has been doing buyback or even merger and acquisition, okay, with an average annual rate of 2%, okay, which means your shares generally on average reduced by 2% per year, okay, due to company buyback. Okay, and if today, okay, you put the demand and supply, of course, we simplify things a little bit over here. We put the demand and supply side in one equation. Okay, demand is increasing about 8%, right? So we understand if demand increase, prices increase. Supply is dropping by 2%. So we also understand that supply falls means price increase, right? So if you put these two together, we have demand increasing by 8%, and if you just put it, equal, which means if demand increase 8%, price tends to increase 8%. Okay, and supply drop 2% means price tends to increase 2%. And then if you sum it up together, what it means that with these two forces over here, demand and supply, generally we would have a 10% increase in price per year. Okay, roughly, right? Give and take. Now, if you put these two together, then that's where you start to see, oh, this makes sense, right? Why? Because if today you go and look back at 50 years average, okay, what is the annual return of the S&P 500? You do realize that it comes to about 9 to 10% on average, right? And again, these are not figures that just being plucked out or suddenly the market just decide to do a 9 to 10% on average return every year, but it's really because of the demand and supply factors. Okay, so when you understand this, of course, this is a simplified understanding, but it's already sufficient to understand the market itself, what constitutes it. Now, if you look at what happened last year to this year, okay, supply side, okay, which is the money supply, right? So it's basically the demand for credit has increased by 20%, okay, last year, of course, okay, and that's where you start to see S&P actually breaks all-time high. Last year return was great, okay. Why? Because of the demand side going up, okay. Of course, last year there's not so much of a buyback, right? But the demand side really pushed price up, okay. So you can really see that in context, okay. So now when you want to understand this perspective, okay, moving forward, of course, okay, that's where you want to ask demand side, liquidity side is currently increasing or decreasing, okay. And in terms of supply side, which is stock buyback, okay, are generally companies doing buyback or are they not doing buyback? Okay, that will give you a good estimate as to moving forward, is the market going to be bullish or bearish? Okay, so over here, okay, that's for general. But if today, okay, you go and look at what's happening right now and we put things into today's context, that's where things might get a little bit different, okay. And I'm going to share with you why, okay. Because for the past 50 years, things might look good, okay, but moving forward, things might be a little bit different right now, okay. But over here, up to today, up to this part here, I hope it's clear, where you guys understand why, what is liquidity, why liquidity has an impact into the stock market, to give you a better understanding what really move it, okay. Now this principle is very important because it becomes the base understanding of what we're going to talk about moving forward from here as well, okay. Yeah, so hope that's clear. Now, so the idea again, to sum up a little bit on the liquidity part, and then we'll talk a bit more of today's context, why things are different, okay. So to sum up a little bit, right? When inflation is high, which is what we are expecting right now, okay, the Fed needs to step in, right? And that's where a lot of traders and investors are basically looking at the FOMC, looking at the Fed monetary policy statement to keep track of what the Fed will be doing and what is the projection of like interest rate next 2 years, right? And with the latest update, we are expecting a minimum of 2 hikes coming in 2023. Okay. So when inflation is high, what the Fed will do is they need to start tightening, which is where we are right now. Okay, we are in a transition period, right? Because last year we are in quantitative easing, interest rate is low. Then moving forward into 2023, that's where the tightening might start, right? Interest rate starts to increase, and maybe the Fed will start to reduce the asset purchase program. Okay, at this moment, to give you some stat, the interest rate, of course, I think most of you will probably be aware, we are at 0 to 0.25%, and the asset purchase program right now is happening about 120 billion per month. Okay, so there are 2 metrics you want to keep track of when we talk about this, right? Number 1, is the Fed gonna move forward their tightening process, which means right now expected interest rate is gonna be starting in 2023 with minimum 2 hikes. So will this be brought forward? Will interest rate starts to increase maybe by late 2022, or would that be maybe 4 interest rate hike in 2023? Okay, maybe the frequency becomes faster. The second metric is the asset purchase program. So right now it's happening at about 120 billion per month. Is the Fed is going to start reducing this moving forward? Is it going to become like 100? Is it going to become 80? And then eventually it stops, right? So you need to keep track of this from now onwards moving forward, right? Because we are in kind of like what we call a crossroad, okay, where the Fed is making very, very important decision at this moment, and that's going to have an impact in the market as a whole, okay? So when the Fed is doing tightening, which is moving forward what we're going to experience, okay, what will happen in the money supply side of things, which is liquidity, is that liquidity will drop, okay? And when money supply drops, the cost of credit increase, right? So I want you to see how just now what we talked about, how it's affecting it. Now, when all this is happening, okay, there are less liquidity in the market, then the stock market will not likely be supported, right? Where we might likely see a bigger move, maybe a mini crash, maybe a 20% drop, a 15% drop. Of course, we won't know for sure what is the extent of it, because it really depends on the factors that the Fed are doing, right? How fast they're doing tightening. Is there any surprise element? Is there a panic? Is there a fear? Okay, there are multiple factors to it. But generally, the understanding you want to take away from here is, if inflation is high, which is what we are expecting right now, the Fed will start to think about tightening. And when this tightening process, the liquidity will drop, and that would have an impact in the stock market. Okay, so in short, when there's a high liquidity environment, the equities market tend to be supported. They are bullish in nature. Okay, and when we are in a low liquidity environment, the equities market are going to be bearish. Okay, so the question now is, right now, okay, today, what state are we in? Okay, so over here, I'm going to share with you some indicators and metrics that I use to gauge the current market liquidity. Okay, and these are pretty accurate, right? In a way, it's going to give you a good 6 months up to a year projection. Okay, so the idea is, if today this indicator here tells me that liquidity is low, there's a very good chance within the next 6 months we're going to see the market tank. Okay, and vice versa, if today this indicator here, this framework tells me that the current market is still liquid, then within the next 6 months, we're likely still going to see the market being bullish. Okay, so generally how to read this? Okay, you can see right now this is updated as of July. Okay, and the overall liquidity as of now is at the 3-point status. Okay, so the max is 8 point. The worst, based on this metric over here, is -8. Okay, and the middle point, of course, is 0, right? On this chart here, the middle point is 0. So as long as the macro liquidity overall over here, okay, is beyond 0, is more than 0, generally we are still in a pretty liquid environment. Okay, however, if it starts to drop, right, let's say from 3 it goes to 1, goes to 0, and then maybe goes into negative territory, then we want to be very, very, very cautious, which means that the market might rotate into a bearish mode. Okay, to give you some context on this, right, in terms of the scoring system over here, last year when the Fed decides to do massive printing of money, somewhere in March, April last year, the macro environment was 5 points. Okay, so it was very, very liquid, and that's where we see last year general market just keep going higher. February or January to February this year, okay, at the start of this year, the macro liquidity here is about 1 point to 2 points, somewhere around there. Okay, and that's where you see the market starts to correct a little bit earlier this year. Okay, and as of July, which is this month, okay, we have a score of 3. Okay, so in other words, generally the market right now is still pretty supported. Okay, so this gives you a clue. For the next 6 months, you do not need to be over worried. Okay, but that does not mean you get complacent. Okay, so today I want to share with you why moving forward things might be different, and you need to be absolutely cautious. Okay, you need to be at least mentally, financially, strategically prepared for what's coming. Okay, it sounds scary, but I think if you're being prepared, okay, then you'll be able to handle that way better. Okay, so what's next? Okay, so what you really need to take note of going into 2022, and why I say this time around things might be different. Okay, so just now we talk about debt cycle, we talk about how the Fed monetary policy affects the financial crisis, affects the debt cycle. Okay, that's where we talk about the short-term cycle. Okay, and that's your financial crisis. Very common, right? Nothing too shocking. Depending on how many times you have encountered this, right? For me, it's 2008. Okay, last year. Of course, the earlier ones I'm a little bit too young to even understand what's happening. Okay, but a good average of 8 years, one recession happens, one crisis will happen. But that's a small scale crisis, right? It's a short-term debt. Okay, the other one that I think you might need to prepare in case it really happened. Okay, I think it's not about whether it will happen or not, but it's more of like when. Okay, now if you believe that history tends to repeat itself, then it's not about a question of whether or not it will happen, but it's a question of when it will happen and to what extent the circumstances of it is going to happen. Okay, so that one that we are talking about is what we call a long-term debt. Okay, and the previous one that happened was back in 1930s, and that's where the Great Depression actually happened. Okay, so this is basically like your small debt cycle, keep stacking up, and then eventually, a big one that just boom. Okay, it's like a bubble that eventually just busts. Okay, and this long-term debt cycle usually happen a good maybe about 75 years, cycle. And if you look back, okay, back in the last Great Depression in 1930s, you add about 70 to 80 years. We are actually right now in that period, right, where it can happen already. Okay, but whether is it gonna happen soon, in the next 5 years, next 10 years, honestly, I won't know, right? I don't think anybody will tell you that. Will be able to tell you that unless they have like a massive crystal ball. But the signs are showing. Okay, and that's the reason why I'm suggesting that you want to be at least mentally prepared. Right? So this is the part also known as the destruction of debt, right? Where you need to wipe clean. Okay, because the debt is so huge that there's no way you're gonna repay it anymore. There's no way there's gonna be a refinance of the debt, and therefore, something happened, and then just wipe clean, click the restart button. Okay, so why I say this time round you want to be cautious of that. Okay, because of two metrics over here. Okay, so this is the Fed funds rate, and if you take a look all the way back in 1980s, okay, it was at the peak, and then since then the interest rate has been in a downtrend. Okay, and when we talk about short-term debt cycle, right, recession, can you see? Okay, so the gray color ones are all our recessions that happen, right? So every time there's a recession, what happens is interest rate drop. Okay, and then of course when interest rate drops, inflation picks in, the Fed needs to hike it up again, right? You need to hike rate a little bit, and then it push back up, and then when the next recession comes, it needs to reduce it again. And then after that, hike it up again, and then the next recession comes, it drops again, and then hike up again, and then it drops again. Okay, but what is shocking over here that I want you to observe is that every time it drops, okay, it goes lower, and every time it rise, hike rate, okay, interest rate wasn't able to break the previous high, so you always get a lower low, lower high. Okay, and if you take a look at where we are right now, okay, in the last 2008 crisis, the Fed has already dropped interest rate to 0. Okay, and the hike did not actually break the previous one as well. And then what happened in 2020? It needs to drop interest rate again, and it drops to 0. Okay, so if you take a look at this trend here, right, what is going to happen is, number one, okay, maybe the Fed increasing rates are not going to increase more than like 2.5, okay, because that's where the previous peak is. And if the next recession were to come back in, the Fed basically runs out of ammunition in terms of interest rate, right? Unless they go into negative territory, which as a global reserve currency, dollar being the global reserve currency, right? The Fed can't really go into negative territory, right? Because if today your currency is in negative interest rate, how nobody will want to hold it, right? And that would not act as a reserve currency anymore if nobody wants it. Okay, so we are actually again in this phase where things are slightly different from what has happened in the past, right? Because we are in this condition right now where interest rate wise, there's no more downside, okay, that the Fed can really play around with it. Okay, so that's on the interest rate side of things. Now the second part here you want to keep an eye on is of course the debt. Okay, I think this one is it's not new to all of you already. We all know that the debt on the US side is just increasing. Of course, last year itself has a massive increase as well in 2020. Okay, so at one point in time, we need to wipe clean this debt, right? And that's where the big debt cycle comes in. Okay, the destruction of debt. Okay, so this two chart here really tell us to be cautious. Okay, things might be different. Okay, because from interest rate point of view, there's no more downside the Fed can do. Okay, and the debt is piling. It's not like it's dropping, right? It's still increasing. Okay, so over here, to give you one more chart, right? This is actually from Ray Dalio from Bridgewater. Okay, if you're interested, you just go and Google on YouTube. Is the stock market in a bubble by Ray Dalio, right? The video was actually released in June 2021. Inside, he shared this chart, okay, where I took it and then just share over here with you guys as well. Okay, the interesting thing to take note is back in 1930s, that's where our Great Depression happened. Okay, what happened is this, right? At the top is basically your debt, right? So you can see debt actually builds up, and then at one point in time, it needs to do the destruction of that, right? Okay, and then at the bottom over here, the blue one is your interest rate, okay, and the red one is basically your money supply. Okay, so if you take a look at what happened in 1930s, okay, is where interest rate basically dropped to zero, and there's massive surge of money supply. Okay, and then what happened? We are going into that major Great Depression, and then after that, Ray Dalio called it a new order, right? Where the whole thing wiped clean and then things restart itself. And during that phase, okay, what basically wiped clean the debt is our World War II. Okay, whether is it really because of this that causes World War II, or is it World War II that causes the kind of like the clean state where we restart? We won't know which one, right, come first. But these two events happened during that period of time. Okay, and that's where, if you look at the current state, okay, where we are, we're basically at the zero interest rate and money supply has surged, right? And that is again at all-time high. Okay, so the question is more of like, are we gonna see something similar back in 1930s? Okay, nobody can answer that, but I just want to share with you these are what happened in the past. Okay, and if you believe that history tends to repeat itself, then there's a good chance it will happen as well in the future, right? The question is just when. Okay, so do take note of that. Okay, this is something that I thought you guys should be aware of. Okay, if you're not. So the destruction of that moving forward. Okay, what is it going to be? Of course, we won't know. But the question more of like to protect yourself, to prepare yourself mentally, strategically, and even maybe financially. Okay, is to consider some of these things that can happen. Okay, so the first is maybe we're going to see a massive devaluation of the dollar. Okay, which means the dollar basically is worthless. Okay, going into the future. Are we going to see a World War III? Okay, we all know how to say. Okay, will US lose its superpower authority? Will the next one be China? Okay, we will know. Okay, or is the US dollar gonna lose its global reserve currency, and maybe a new crypto, digital world currency is gonna come out? Okay, or maybe Chinese yuan is gonna be the next global reserve currency. We won't know. Okay, but the part here is more of like for you to consider some of these possibilities of happening so that you can prepare yourself way ahead before it happens. Okay, hopefully that helps, right? It's a little bit not very positive, but I think you need to prepare for the worst case scenario, which in this case, if this happens, right, you know how you can react from that. Okay, so putting that into perspective, for me, one of the actionable things that as an investor and trader you can do is to start hedging a little bit in terms of your portfolio. Okay, when I mean portfolio here, it can be really your net worth. Okay, and two asset mainly that is pretty common and popular is gold and silver. Okay, so over here, of course, gold, if let's say the dollar is going to lose its reserve currency, maybe gold would be a good asset to be hedging against, right? Because then it can be packed with maybe the next reserve currency. We won't know, right? But gold is generally a good asset to be hedging against inflation. Okay, so again, I always look back at what has happened in the past, and then we reference to what can happen in the future. Okay, so if you think back, what happened in 2009, which is where after the 2008 crisis happened. okay, to 2011, which is somewhere here, okay, you do see gold actually made a move of about 180%. Okay, so within 2 years, gold rallied 180%. Okay, so very simple. I just do a quick projection of the recent low here, okay, to 200% projection to the upside. Gold price will be somewhere around $3,000. Okay, as of today, probably it's trading around 1,008, right? So halfway there. So the question now is, will gold, okay, push up and head towards 3,000 with the upcoming inflation? Hard to say. Okay, we won't know for sure, of course. Okay, nothing is 100% guaranteed, but it's a good opportunity to keep an eye on. Okay, so this is something for you guys to take note of as well. One asset that you want to maybe focus on to protect yourself against inflation moving forward is gold. Okay, the other one, of course, is silver. Okay, so these two are correlated as well. Silver over here, same thing, right? We look at what happened in 2008, 2009, all the way until 2011. Okay, 2 years silver rally 500%, right? 490% over here. Okay, so same thing. I do a simple projection from the low. We did a projection up of 490%. It will result in silver at $68. Okay, so same thing. Today silver is trading somewhere around 26, right? So we are like still have halfway there. Okay, so again, you can consider silver as a potential hedge against the upcoming inflation. Okay, it's not going to be a short-term thing, right? Because this here, you can see in the past, it took 2 years. So the question now is it also going to take 2 years, right? If it's 2 years, then what's going to happen is 2022 to 2023, that is the 2-year window period. Okay, so this two asset is something that you guys can take note of. Okay, so over here, as I mentioned just now, right, we won't know exactly when. Okay, no traders, no investors would know, but the signs are there. The indicators are there telling you to be prepared. Okay, so over here, just like I mentioned, right, mentally, strategically, financially. Why I say that is because mentally you need to be prepared because it might be a total shift of paradigm moving forward. Okay, because right now we are like having the US being the big player, right? Moving forward, we might not have the US, right? So it's a total paradigm shift, right? Would the US market still be the world, most vibrant stock market? We won't know, okay? But mentally, you need to prepare that things might be very, very different. Okay, strategically over here is more like having all this. How are you going to prepare yourself as an investor or a trader, right? What is your strategy going forward? That's where I think it's good for you guys to start thinking about it. Okay, and financially, of course, it becomes more like if today you're holding a lot of dollar, right, and you understand that there's a good chance that dollar value will drop in the future. How are you going to protect yourself financially? Okay, so that's the idea behind all this. Okay, so one thing that I would be very confident to tell you is that moving forward this year to next year, okay, we are definitely in an uncertain environment, okay, where the stock market are gonna be a little bit more choppy, okay, and things or concept like just do passive investing or just buy and hold, or you look at the market and then just anyhow buy one stock, it's not likely going to be very effective. Okay, where profits are not so easily made going forward. Okay, compared to like last year, honestly, anything you buy, you make money. Okay, so moving forward, things are not going to be like that. Okay, so you definitely need to be I would say a little bit more prudent in the stock that you choose to trade, the stock that you choose to invest. Okay, so with that then while I'm painting a very, very gloomy picture moving forward, some of you would then be starting to ask, right, then Kar Yong, should we still be trading and investing, or should we think of the worst case scenario and pull out all our funds and then put it into the bank? Now, to answer this question, of course, it really depends on how well you're equipped. Okay, so my answer to this is that yes, you can and you should still be involved in the market, okay, if you know what you're doing. Okay, because it's during this period of time you're either gonna have the opportunity to really profit a lot, or if you really do not know what you're doing, you might lose a lot. Okay, the risk is there. So yes, I would say you should be still trading and investing if you know what you're doing. Okay, and of course, this is given that you have a sound strategy, okay, and a proper investment thesis, right? What I mean by this is, for example, right, if today you're following on, let's say, Telegram, you're following on some Facebook group where someone says buy this and then you just buy that, that is not a proper strategy. Okay, that is no strategy at all. You're just blindly following. Okay, that does not come here, right? That's not considered as having a strategy. Okay, having a proper and sound strategy or investment thesis is more of like you have a good framework in understanding why you're buying this, why you're selling this, why you're trading this. Okay, you have that conviction level in every decision you make. Okay, that's what we meant by a proper and sound strategy and investment thesis. Okay, so if you do not have that, then you might want to come up with one first, right? You want to establish that before you even start trading, because moving forward, as I mentioned, things are not going to be as easy anymore. Okay, and of course over here you want to be selective of your stocks, right? Which means just like I mentioned, right, you can't just buy any stock and then expect it to go up. Things are different right now. You want to also start being a little bit more active in managing a position, which means that if today you're starting to see some profits, you want to maybe move your stops to protect a bit of all these profits more actively. Okay, and of course, having said that, passive investing might not be very effective. Okay, which means just buy and then let it hold for the next, maybe, I don't know, 5 years, 10 years. That strategy might not be effective moving forward. Okay, so this side here, what you need to take note, right? If today, again, if you're buy and hold, okay, you might want to rethink it. Okay, I'm not saying that you're gonna lose money on this, but you want to rethink this strategy. Okay, there is certain phase or period in the market where this is solid. Okay, but there's certain phase in the market where this is not effective. Okay, so dollar cost averaging buy and hold, you might want to re-strategize a little bit. Okay, that's my personal opinion, right? Might not work very effectively. Okay, if you have no strategy, okay, as I mentioned just now, if you're blindly following what people are doing on social media, don't do it. Okay, and of course, if some of you here are looking at options trading, okay, moving forward is not going to be as easy. Okay, why? Because during an uncertain environment, volatility is high. Your options market is going to be more expensive, and if you're very new to options and you have no idea how to manage the environment, very easy, you can lose a lot of money in the options market. Okay, so just be careful. Okay, just be careful on that. Okay, now why I say this is not that it has not happened before. Okay, it does happen before. If you take a look at this chart over here in the S&P, okay, this is back in March 2000 to 2013 in April, so that's a good like 13 years. Okay, the market was basically sideways all the time. Okay, which means that if you're so unlucky you got in at the top, okay, you need to wait a total of 13 years before you eventually see a slight profit. Okay, ask yourself, how many 13 years do you have? Okay, and during this 13 years, how much would you have suffered if you are trapped in this environment with a passive investing strategy? Okay, some of you are interested in STI, right? Long-term invest also. I would say don't long-term invest in this straight time index. Okay, it's not very effective. Okay, so just want to give you this perspective over here. Okay, moving forward, I don't know, maybe for the next 10 to 15 years we might be in a choppy environment. Okay, so be aware of that. Okay, so buy and hold is not that gonna be effective. Okay, so some food for thought for you guys over here, and then share with you some statistics to help you make some decision, and then we'll open up for Q&A. Okay, so now food for thought. Okay, to kind of like give you some ideas to start thinking about. Okay, now in the world of finance, right, to simplify everything, it's basically all about money flow. Okay, so in this financial sector where we talk about investment and trading, right, we do have multiple assets. Okay, you have the equities market, you have the bond markets, you have the FX market, you have the commodities market, and then of course from here you can branch it out to different derivatives, right? You have like options, futures, spots, CFDs, ETF, etc. Okay, so if you really understand that and look at it from a four asset perspective, okay, so you have cash, which is your FX market, you have equities, you have bonds, you have commodities. Okay, it's all about money flow, right? What I mean is that when money starts to come out of equities market, it will go somewhere. The question is more of like which asset is it flowing into? Okay, and as a trader and investor, okay, what you want to then look out for is to find out likely where the money is going to go in next. Okay, so when money comes out from, for example, right, stock market, naturally where this money will go, it will probably go into the bonds market, right? Because bonds are seen as a safer asset, right? Safe haven, right? And vice versa, if market money comes out from the bond market, where it will go? Probably the stock market. Okay, so you want to actually identify where this money is likely going to go, and then you capitalize on that opportunity, okay, before the mass market picks it up, right? This is very important. What I mean by mass market is that if today you see something reported in the headline, is done, okay, means the move is already done. Don't go and chase it anymore, right? For example, if you look at headlines and you look at and for example, right, very recent, S&P and Nasdaq beats all-time high. That is already done, and therefore the media reports it. Okay, that does not mean you go and buy it, right? Because it's already moved up. Okay, then the next natural thought that you should have is, okay, so if let's say something is going to happen in the market, the money is going to flow out of the equities market, where is it going to go next? Okay, and then you want to capitalize on that. You want to maybe start positioning yourself in that new asset before money starts going in, and then all the mass market starts to go in to push price up. Okay, so this is something that you want to think about, right, as a trader and investor. Okay, and you want to avoid crowded market. As I mentioned, if today the media is already picking it up, it's already crowded. Okay, it's already done its move. We call it the hot potatoes. Okay, don't go into those, right? Because very high chance you're gonna burn yourself when you jump into those assets. Okay, so take note of that. Okay, so to give you some understanding of certain sectors that you can focus on before the money flows into it. Okay, I'll leverage, I'll kind of like use the concept of sector rotation to give you some ideas of it. Okay, so over here, this is again updated as of July, which is this year, this month. Okay, we are actually in the rotation of full recession going into early recovery, and soon we'll probably jump into full recovery soon. Okay, and by understanding which transitionary phase we are in the economy will allow us to know like which sector tends to be performing better. Okay, so right now we are in this sector where we are more or less in the early recovery, and soon we might go into full recovery. Okay, so some sector that you want to focus on are probably your basic industry, energy, and maybe staple. Okay, these are the three sectors that you might want to start putting some focus on. Of course, energy, you might already see this year, earlier this year, it has boomed. Okay, of course, recently it seems to be pulling back quite significantly. Okay, so I'm not saying that it's just going to go all the way one direction up, right? Everything goes up will likely come down a little bit as well, and then reset and then move again. Okay? So I'm not saying that immediately go and buy into all this sector, but you might want to focus on these three sectors here. Okay, basic industry, which is your materials, energy, and of course staple. Okay, staples here are consumer staples. So when inflation starts to pick up, okay, consumer staples tends to be performing quite well as well, right? The reason is because the idea of consumer staples is like they are in a sector where people will need it anyway, right? Things like maybe your food, basic necessities, right? When inflation happens, when general prices of goods and services increase, people still need those products. Okay, so this sector tends to still perform pretty well. Okay, so that's where you might want to focus on some companies they're in this sector, right? For example, P&G, Colgate, okay, Walmart, right? Costco. These are some of the companies that immediately I'll think of when I talk about consumer staples. Okay, so have that in mind. Okay, so over here, I want to share with you some seasonal data to give you some information to help you as well along the way. Okay, so first up, we'll talk about the S&P. Okay, and the idea of all this seasonal data, if you're very new to it, the idea is we look back at the past 10 to 15 years to understand which period the market tends to rally. Okay, so in this case here, we're looking at the probability of about 70 to 80%, which means based on past 10 years, there's a good 7 to 8 years it rally. Okay, or if you're looking at the sell side, then there's a good 7 to 8 years it drop. Okay, so that's what probability and reliability means. Okay, so take note of some of these dates. Okay, you might want to look at for the S&P market. It starts off in 27th of October to 6th November. Okay, it has a good 70 to 80% chance it will rally with an average rally of 2.7%. Okay, after that it will be 20th of November to 6th December. Okay, so also average about 2.3%. And the last one here is of course your Christmas rally. Okay, which is on 14th December to 3rd January. Yeah, so that's on S&P, right? If you want, quickly take a screenshot, jot it down somewhere, right? Those of you who are trading on S&P, this window of period will be something that maybe would help you in your decision-making process. Okay, gold, okay, which is also definitely an asset that you want to pay very close attention to as a potential hedge against inflation. Okay, so this one here, the reliability factor is 80 to 90, slightly higher. Okay, so it's bullish for 24th of July to 3rd September, which is soon, right? We are getting into this phase. So take note of that, okay, for a potential inflation hedge. However, after 3rd Sep, for the month of September, gold tends to be having the probability of bearish. So you might want to then maybe look to take profits if you're making money, by September, or you might want to then see any chance if let's say September market comes down, you might want to look out for opportunities to accumulate gold as well. Okay, so for the long run. Okay, so there are two ways you can play around with it. You can trade it in a specific direction, or you can use it for an opportunity to accumulate as well. Okay, in late October to end of the year, okay, generally commodities are bearish as well. Okay, why? Because the stock market tends to rally at the end of the year, right? After October, and that's where money flow again, right? When the stock market is rallying, money needs to come from somewhere. Okay, so in this case here, it can come from gold market. Okay, so again, you might want to take a screenshot on this. Okay, now I also added in a little bit in terms of different asset classes over here. I'm personally looking at TLT, which is bond markets as well. Okay, so over here, sharing with you some stats as well, right? From July, which is pretty much, we're closing in right now, 27th of July to end of August. Okay, it's actually quite bullish for the bond market. Okay, again, vice versa, right? When the market starts to drop, your bond market tends to be supported. Okay, however, after August to mid-September, the bond market is bearish. Okay, and then after that is bullish back again for another 2 weeks. Okay, and then after that it becomes bearish until November period. Okay, so again, you might want to just quickly jot down these dates, right, to help you in some of your trading decision, okay, trading or investing decision making process. Okay, now some sectors that we just now highlight as well, I share with you some of the seasonal stats, right? So we talk about XLP, which is your consumer staples. There's a good reliability factor of 85% that it will rally between 29th of Sep to 29th of November. Okay, so if you're looking at protecting yourself against upcoming inflation maybe next year, then you might want to position your portfolio a little bit into XLP as well. Or if you're looking to trade it, okay, you might want to consider trading this ETF from September to November to the upside, right? Okay, the average return is about 3.32%. And if you annualize this data, right, it becomes 21%, right? What is annualized mean is that basically you take September to November, that's a good October, November, 2 months, right? So 2 months with an average return of 3.32% in 2 months. Annualized means you compare it into a year return. Okay, so the idea is if the stock market on an annual basis, okay, generates maybe about 10%, if you only trade this period of time, you're actually outperforming the market. Okay, that's what it means. Okay, so XLP, take note of this date. XLB, which is basic materials, just now we talked about this sector as well. Okay, between 27th of October to 6th January, again, this is the period where it has a high tendency of rallying. Okay, so you want to take note of this data. Okay, and the last one over here is energy sector, right? So same thing, the dates is more or less the same, end of October to beginning of the following year. It has a good probability of rallying. Okay, yeah. So hope some of this data here helps you guys a little bit. Okay, so great. I might have extended a little bit, okay, but no worries. I think it's still important to have the Q&A to see if you guys have any questions that you want to clarify, okay, so that we'll be able to answer and see if any parts are not clear, okay, to help you clarify that. Okay, yeah, so what you can do, I think you guys will be able to just type it into the chat box, and then I'll be able to look at the question.
The question box actually, Kar Yong.
Oh, I'm not able to see them here though.
Okay.
Yeah.
Let me see what I can do. Okay, are you able to see it now?
I see it. All right. Okay, so I see Lim asks, is there a season for silver? Yeah, actually, if you look at maybe I'll go back to the slides here on gold. Okay, they are more or less similar, right? Silver and gold. Okay, so if you're looking at silver, generally these stats here are more or less the same. Okay, so Lim, who asked about that, hopefully that clarifies it, right? Gold and silver more or less the same. Okay, Sheng here asks, can you show the image of XLB? Okay, XLB would be over here. Okay, so this is the stats for general materials. Okay, Bremen asks, is TYO, which is 7 to 10 years treasury, still good to go with inflationary theme? Okay, now maybe to share with you a little bit on my personal view on the treasuries, right, which is basically our bond market. Okay, I would say in the past it's always viewed as a safe haven asset, right? Which means when anything goes wrong, likely the bond market will rally, and then people would see it as like a good safe haven. Okay. However, you want to be cautious moving forward, right? Where just now we talk about things might be different moving forward. Why? Because interest rate is already like all-time flat, right? Zero. Unlikely the Fed is going to go into negative. Okay, and there's a good correlation between bond yield and bond price. Okay, and bond yield has an effect. That means interest rate will have an effect on bond yield as well. Okay, so the idea is always inverse, right? So if bond price goes up, bond yield drops, and bond yield goes up, bond price drop. Okay, and if you simplify the whole thing here is that if interest rate goes up, yield goes up. Okay, so it's a little bit oversimplification, but it's to help you understand easier. Okay, so the idea is if you're looking to buy bond, you want bond price to go up, right? And for bond price to go up, you want the yield to come down, and for the yield to come down, you want the interest to go down too. Okay, that's how you want to do long-term investing for bond. But if you understand that there's a limited downside of interest rates, then maybe the yield might be capped as well. Okay, and for that reason, it might not be very attractive to look at bonds for the long run. However, if you're looking at it for a potential hedge, okay, maybe for the short term, with volatility kicking in, with uncertainty kicking in, then putting some part or allocate some of your portion of your portfolio into bond might be okay, might be even a smart move, right? That's my view on it. Okay, so I would suggest some might even argue that there's a potential bond bubble building up. Okay, so you just want to be very careful on that, right? For me, if you use it as a hedge, it's still fine. But if you're looking at it for to grow your portfolio in the bond market, just be very careful on that element. Okay, so hope that helps. Good. Okay, so okay, I see Rachel here asks, whoops, okay, give me a while. Okay, the questions are jumping. Okay, so I see here Rachel asks, can you show? Oh, okay, I skipped one question. Okay, so Jeff actually asks, what exchange or platform is strong for gold exposure? Okay, actually, you guys, I wanted to show you this as well. If you go over, oops, okay, to Phillip Futures on the MT5 platform, right? They do have the gold instrument as well, and in fact, just now we talked about some of the sector rotation, right? Like energy, consumer staples, and basic materials. They do have access to that as well, right? So you can look at that. Okay, so I actually did some simple analysis for you guys. Okay, maybe if you go over to the website over here, okay, you can take a look at that. This is for July, right? So if you take a look at gold over here, right, we did some analysis for you as well. Okay, so Jeff, and of course for those of you who are interested, you can actually get access to all these asset classes, plus also the sector that we talked about just now, okay, on MT5 directly, okay, on MT5 directly. So this one, if perhaps you want to understand a little bit more, you can actually contact Phillip Futures as well directly to maybe guide you a little bit on how to download MT5 and where to get open up all these charts where you can access to. Okay, Rachel here asks, can you please show our XLP slide? Okay, sure. XLP is this one here. Okay, consumer staple. Yeah, so you can take a photo and things like that. What I did over here, okay, so quickly do that and then I'll bring you over to the chart. Yeah, so done. Okay, so XLP over here, I did a quick technical analysis for you guys as well. Okay, of course, if you combine what we've mentioned just now with technical charts, you do not want to buy now, right? Okay, this is the consumer staple price chart, okay, on a 1 hour time frame. Okay, two key levels you want to keep an eye on, okay, is that you might want to wait for price to perhaps come down to it somewhere around $68 to start accumulating it. Okay, so what we cover today is not something that is short term immediately today you go and buy them. Okay, but if you look at it from the bigger things, bigger picture perspective, and adding in the reliability and seasonality over here, okay, XLP is somewhere around late September. That's where you start to look at it. Okay, so if you put that and confluence it with a little bit of a technical analysis, okay, maybe you want to give it some time for it to maybe come down lower, somewhere around at the price of 68. Okay, that's where you then look out for an opportunity to accumulate a little bit on the consumer staple sector itself. Okay, so you can actually look to trade, on MT5 directly the ETF, right? That's one way to do it, which means you basically trade the entire sector. The other way you can look out for is maybe individual stocks, right? Okay, so for example, individual stocks over here, you can look up for okay, consumer staples like Coca-Cola actually falls into that. Okay, where things are good, things are bad, people still drink. Okay, and then another one like 3M. Okay, is a mix of like basic materials and also a little bit towards like consumer staple, a bit on that. Okay, Walmart. Okay, so you can see over here Walmart. Okay, McDonald's. These are all considered a little bit on the consumer staple side. Okay, so you have various options, right? You trade the ETF directly, or you look at individual stocks within the sector. Okay, of course, you need to have a strategy, whichever that you feel is suitable to you. Okay, so hope that helps. Linda here asks, where can we monitor the liquidity situation in the market? Overall now is 3. Okay, Linda, there's a few ways you can look at that. For me, I'm using that framework, right? That few indicators, and then I'll just compile it into a point system. Yeah, so that's how I do it, right? If you like to understand a little bit on that, okay, I might need to bring you back to that slide. Okay, and then you can do a very quick look of that. Let me quickly go over to that slide. Okay, these are the few indicators that I use, so maybe that is going to help you a little bit. Okay, over here. Okay, so some of the indicators you might want to be interested to track is over here. Okay, so again, you can quickly take a screenshot and then look at them. Okay, this data here are all taken from Fred. Okay, so if you go over to the website, you'll be able to find that as well. Okay, another question I see over here, what is the take on NVIDIA after stock split? Honestly, stock split does not really change any fundamental of the company. Okay, so nothing has really changed, right? Stock split are just basically a psychology effect of price coming lower. That's it. Okay, fundamentally, nothing has changed. Okay, so if your investment thesis is still bullish on NVIDIA, this does not affect it. Okay, basically nothing has changed. It's just price. Okay. What is your take on PSTH? No, this is not in my watch list, right? Yeah, PSTH is not in my watch list. Okay, I might not be even, okay, honestly, I don't know. I don't recognize this taker symbol. Okay, so it's not in my watch list. Another question over here I see is the Hong Kong dollar pegged to the US dollar. What do you think will happen to the Hong Kong dollar, which is also linked to the market if things happen in the US? Okay, very good question. This is from Kwong, right? Okay, so this is on the FX side of things, where Hong Kong is basically pegged to the dollar, right? So if there is a certain peg, right, it's definitely not going to be like a fixed pricing, but it's maybe a band, right? So the idea is, of course, if the US dollar is going to drop, and because right now there is that peg, okay, Hong Kong dollar likely will follow suit. Okay, it will likely drop as well. Okay, and vice versa. If the dollar actually strengthen, then Hong Kong dollar will strengthen as well. Okay, so yeah, that's how it works. If you look back at what happened in dollar and franc last time, there is the floor as well. Sorry, euro franc. Okay, there is a floor as well where the central banks tends to defend that floor. Okay, and prevent it from going lower from that, right, until they decide to remove it. So who knows, right? Maybe this peg between Hong Kong dollar and US dollar might be removed as well in the future. We won't know, okay? But as of now, because they are pegged, then more or less they're going to move in the same direction. Okay, so yeah, hope that answers your question. Great. Okay, any more other questions that you guys have? Okay, if not, then I really hope today's sharing is able to give you some insights into the current market condition, right? And of course, the idea here is to give you some food for thought to protect yourself against what's potentially happening. Okay, good. Okay, so great. Okay, so maybe I'll go back to the slide here. If you guys would like to, if you can, if you want, okay, you can scan this QR and then you can actually download that MT5 platform directly. Of course, if you need help, you can always reach out. Go to the website and reach out to Phillip Futures for assistance on the installation of MT5 as well. Okay, so good. Okay, so if there's no more questions, I hope you guys learned something from today. Okay, and then what I'll do is I'll pass the time back to Sri.
All right, thank you so much, Kar Yong. It was truly insightful, and at some points it was quite scary as well. Once again, thank you for being a wonderful audience. Yes, just as Kar Yong mentioned, you can request a platform demo. We will be sharing the links to, when you request a demo, you will also get the links to our user guide videos, so it's quite user friendly. You'll be able to pick things up in a jiffy. If you have any other questions for the speaker, Kar Yong, or for Phillip Futures, please type them into the survey form which you will receive right after this webinar. All right, and once again, thank you for being a wonderful audience, and do join us for our next upcoming webinar. Thank you so much. Good night and stay safe, everybody. Bye-bye.